I think you can take a snapshot in time, maybe a 1 or 2 year period, looking at some standard moving average levels and see if the stock actually reflects that it relies on those. You know, if you find
Welcome back, traders and investors. We have Ashraf Laidi on the line. Laidi. He is from Hamzei Analytics. He is a HFT Forex trader. He's been on the show before here. How about the volatility in all the markets? How you been navigating it?
Very good, very good. Let me just clean out the title, and I'll just, because it's a mouthful. So it's Ashraf Laidi. I'm a Chief Global Strategist for City Index. I also give the trades on ashraflaidi.com, and I also happen to be the lead FX strategist for Hamzei Analytics, which is a high-frequency trading service. How about the volatility in currencies? Boy, where do I start? So we are right now 2 p.m. London time, which is 9 a.m. New York time. Around 12 hours ago, just around the close, or 15 hours ago, just around the close of New York yesterday, we had something very interesting. We saw the stock markets just falling very hard, but we saw something unusual. We saw the U.S. dollar falling alongside the stock market. Why was that? One of the reasons was that story with the airplane in Boston, or with the news that there is one more Ebola patient in the northeast of the United States, which is very important for the markets than other parts. I don't want to make any other people angry here in the southern part of the United States, but that really gave news that there is that this Ebola thing is a big fear. So what we had a knee-jerk reaction, the U.S. dollar falling across the board. That means sterling went up against the dollar, and that was a great opportunity for us to say, sell the bounce in the British pound. The British pound went all the way towards 161.20. Guess what it is right now? It's a 159.20. That's in English called 200 pips in Forex terms. That's a huge. So basically what is going on right now, we saw the dollar pushing back up, but the main story in the currency market is correlations come and go. The new normal becomes old, and then it comes new again. But one thing stays, and that's something we've been mentioning for months and months and months. The one and only currency that is the refuge of safety in market volatility, guess what it is? It's the Japanese yen. And the Japanese yen has been spanking every currency left and right. That's why the listeners who are listening right now, they're saying, how come you kept on issuing a new trade, one after the other, in shorting sterling yen? Well, the answer goes, we can post it on Hamzei Analytics. But basically, here is the thing. The British pound, the sterling, is giving way to very, very bad political risks. What are these risks? There is a party, the political party in the United Kingdom, called the United Kingdom Independent Party, UKIP. What do they want? They want the EU, they want the UK to exit the EU. That is very bad for British business. It's very bad. They are not happy about immigration and so on and so forth. And what is happening, there has been some MPs, members of the parliament, that have been defecting, leaving the incumbent Conservative Party and going to the UKIP. This is as if you're in the United States and you heard a newspaper and you see people who are leaving the Democratic Party to go to the Tea Party, and the Tea Party is growing and growing, and the Tea Party says that we want to move out of NAFTA. Okay, that is not very good news for the dollar, if I were to give a metaphor like that. I didn't hear you ask any question because you've been very silent by my speech here. But this is what's been going on in the market, and thanks for giving me the time to put all that in.
No, I'm used to interviewing Fari, so I'm always on my toes. So let's go to the dollar here, and a lot of the strength has been in the dollars because they're kind of anticipating rates going up in the United States. But the Fed says, no, this is not going to happen. So if this is not going to happen, are we going to see continued strength in the U.S. dollar vis-a-vis the other currencies?
Yeah, okay, that's a very good question. And I think that we have to be careful when we talk about the dollar right now. We have to, it's nice to make an all-encompassing statement and say the dollar, but you would be doing a favor for people who listen right now, because the learning curve is going up and up among the listeners, is that you want to say the dollar against what? But in general, here is what the Federal Reserve wants to do. Listen, I find it useless and totally useless for people to argue about the timing of the rate hike. Okay, there is no point, there is no way the Federal Reserve is going to be raising rates before May or before June. What the market is arguing, whether it's going to be done in August or in September. For the market to be arguing about a time frame of at least 8 months, whether it's 8 months or 10 months, it's useless. What the Federal Reserve is trying to do here, it's been putting the effort on putting yields down, and it's done a very good job. It did a very good job in capping yields by saying, listen, the improvement in the job market is not good enough, and so on and so forth. So what they did, they kept a dampen on bond yields. They are one of the dynamics that kept a dampen on bond yields, but they forgot about the dollar, and the dollar had no choice to go up, no choice but to go up. Why is that? Because I'm sure you guys know, because the ECB has moved into negative. The BOJ is basically is talking down the currency until the last 3 days, and so on and so forth. So, and the fundamentals in the U.S. in general over the last 2 or 3 months have been improving, hands down. So what the Fed tried to do, and what they did in the minutes of last week, was basically, it was not verbal intervention, it was not currency war. They basically acknowledged the obvious. They basically said that, listen, if the dollar continues to strengthen as it has, it is going to hurt exports. Now, when you're a trader and you're listening to this, and when the dollar move has grown too fast, too soon, or too much too soon, technically you need to come back off. I mean, we saw the 7 or 8 consecutive rising weeks in the dollar, which we've never seen ever in the dollar index, in the history of the dollar index, which started in 1973. So you need to take some money off the table, and you need to see a pullback. So I think that when you combine the story of the minutes and the Federal Reserve and so on and so forth, they are a factor among the many factors that are trying to do the following: to maintain the bullish trend in the dollar, but all they're trying to do is to slow it down a little bit to keep it interesting, to make it interesting. So what does it mean? Well, what does this mean? Now, I'm talking as a trader, what I did basically, last week I went into long the euro dollar, but not to long the euro dollar and sit on it for 5 weeks no, it just tactically long for probably 80 pips or 100 pips. We saw a big euro move, but you have to be very smart and you have to be nimble in exiting these dollar shorts. But like I said, the favorite trades right now does not really involve the dollar. It has been involving in the last 3 weeks, people who have been following us or been doing the copy trade. We've been shorting sterling yen. We had 3 out of the last 4 trades shorting sterling yen because of the political considerations that we're talking about the sterling, and because the yen is the best currency right now as the volatility goes back up. But as for the U.S. dollar, one of my favorite longs right now in the U.S. dollar, tactically speaking, it would be right now against the Australian and against the Canadian and even against the peso. Going long euro dollar right now, I would probably short the euro dollar if we see again 127.90 or 127.80.
Why is the Japanese yen your favorite currency?
Listen, this is probably a tough question here to to answer in a very short term. But basically, the yen has been, it's been the yen and the dollar. They have been always the currencies that usually go up during market volatility. And the reason for the dollar being, the dollar part of the answer, being that, money, when it goes in safety, it goes into cash, it goes in U.S. treasuries and so on and so forth. So basically, when money is not being deployed, it goes into cash, the dollar goes up de facto. That's why in 2008 and 2009, when the market crashed, the dollar went up. The dollar went up not because there was a sudden improvement in the fundamentals of the U.S., because basically money left commodities and left, so it went into safety. That is the reason. But that reason only works if there are no big risks in the U.S. or to the U.S. dollar, i.e., if no FOMC speaker comes in and talks in a dovish way, okay? And number two, if there is no new credible, and I say the word, and I underline the credible, no new credible fears in the Ebola. I mean, some people are asking, why are we getting all these fears? Why are we getting all these news in Ebola in the United States? What about other countries? What about in Africa? Well, let's not answer that. But if we're going to see any more news regarding that, that will be an excuse just to pull back. The yen part of the answer, why does the yen go up? Because basically, it is a currency. Okay, so they have been shielded from all this Ebola talk and so on and so forth. But more importantly, the current account situation or the external account situation, as far as the trade balance and so on and so forth, it remains best or the best of the worst lot. And the big declines that we've seen in the yen over the last few months, they've also been good for that. So that's one of the reasons. The other basically reason is that we've seen such a considerable weakness in the yen. The Japanese have been successful at talking down the currency. There's been news that the pension fund in Japan is going to move out of bonds and going into stocks, Japanese stocks and foreign stocks. So that was bad for the yen. So everybody was putting a blindfold on and selling the yen and selling the yen and selling the yen. So as we've seen the VIX going up, not to 19, not to 21, not to 22, but to 24 and almost a 25, okay, that gives basically people with the path of least resistance is to go back to what you were doing best and to put the money into the dollar and into the yen. But the yen gets the edge above the dollar. That's one of the reasons. But technically speaking, I gave you the fundamental explanation. But when I do a trade and so on and so forth, when I do a trade, I look at the technicals. And sterling yen for me, it did something very similar to the S&P. Anybody who likes the S&P and breathes the S&P and eats the S&P and drinks the S&P should listen to the following. And the following is what I said on Twitter. Forget that 200-day moving average. That is Mickey Mouse stuff. That is not what you should watch. It's not the 200-day moving average in the S&P. It is the 55-week moving average in the S&P, which is 1870. Okay, and the same thing for the sterling yen. Sterling yen, it's not the 200-day moving average that you should pay attention. It's the 55-week moving average, not 55-day, 55-week moving average, which is around 169.90, and that's why we were shorting it all the way from 171.50, 172, all the way towards 169.80.
We're getting a comment out of the chat room here that now many business leaders are concerned that the yen is now too low, and that could have an impact on input costs. Do you have any comments on that?
Yeah, it's a very good question. Yeah, exactly. Basically, what the Japanese have been doing when they were successfully talking down the yen was going down so much. So basically, the Japanese, they don't want to be accused by the rest of the world that they are doing this currency war. They don't want to be accused by the world that they are depreciating their currency. So basically, when the yen was weakening so much, i.e., dollar yen was going up fast, and euro yen was going fast, and the Canadian yen was going so fast. It was not good for the Canadians and the euro and the U.S. So basically, the Japanese said, okay, let's calm down these fears, especially when we go to Washington, D.C. with the G7 and G8, and we don't want the fingers pointing at us. So let's just give them a statement that will calm people down and will bring the yen back up. So what do we say? We say, oh, you know what? We don't want the yen to weaken so much, because if it weakens so much, it's going to make our energy imports a little bit too expensive. And they said that, and the yen started to go up, but it started to go even more up when the volatility is happening right now, and when the stocks are falling quite hard, and basically when the FTSE is down 9% or 8% from its highs, when the DAX is down 12%, and the S&P and the Dow are down around 4.5%. So basically, that move was exacerbated.
We have some traders here that trade the ETF, so we got a question. The only way to play the yen is through the FXY ETF. Are you familiar with? I know. Yeah. I'm sure you're just out. Is that the only ETF? Okay. All right. Just going back across to the pond, you mentioned a lot about Europe and also what's going on with in the UK. I mean, Draghi's trying to drum up some QE for Europe. Germany's dragging their feet. I mean, is this something that's going to come to fruition, or is Draghi just reaching here?
Well, the Draghi is doing what he can do within what he can do. I mean, right now, one of the reasons that is really helping the situation to go from bad to worse is that you've got even the head of the German central bank, Weidmann. He basically said, now we're reaching the limit of what we can legally do and not do. And basically, in English, between the lines, what he's saying we are going to do the asset-backed securities. We have reduced interest rates to below zero, and now the market is expecting us, if these things don't work, and if the LTRO or the targeted LTRO doesn't work, then market is expecting us to go into outright QE, and this, according to some German courts, it is illegal for the ECB to do that. So, when the market hears that, they said, oh, wait a minute, just when the market wanted the ECB to really get started and to go into stimulating the policies, now they're going to stop. So basically, the market doesn't want that. Here is the thing: what is very interesting, what is very important, the other reasons that is really helping that has weighed on the euro the last few hours is the ZEW survey, sentiment survey from Germany, which is basically going from bad to worse. And basically, what is happening is that the German situation is we should probably be looking at the economic definition of a recession, two consecutive quarterly declines in Germany. And part of the reason is because the middle size, the Mittelstand, the medium size companies in Germany that make the core of the German economy, these mid-size firms, they are the ones who are seen or who are considered to be unable to deal with the rising sanctions with Russia. And these guys, they depend on a lot of business with Russia. They do a lot of business with Russia. So the more Angela Merkel talks hard and talks bad about Russia, basically it's very hard for these companies to adjust. That's one of the reasons. And so what is really, really hurting the euro is that the German machine, miracle, or the German machine is right now becoming the German producer of contagion. I mean, even Poland, which is an emerging market country, considered to be an emerging market country, which was actually lauded for being exposed to the great Germany, they had to cut rates because it is so exposed to Germany, and Germany now is doing quite badly. So this is the situation. And basically, that's why you got euro-yen is still a good short. It is breaking some key levels right now, euro-yen. The euro-dollar, you have to be a little bit smarter in selling euro-dollar right now. So shorting euro-dollar is not the best trade. But, the PMI, the Purchasing Managers Index, the IFO, the ZEW, all these three main sentiment surveys for German businesses, they are doing quite badly.
You've covered a lot of the fundamental here, and we love it. I know you also are a technical trader, and I don't know if Fari lets you use his Sigma channels or not, but just real quickly, could you tell us what technical analysis techniques?
No, I don't. I use the stuff that I use. I don't use Fari's. Fari's has his own stuff for his own service. I use my own stuff for my own service, and because I'm a partner with Fari on the HFT Forex, yes, we're a partner in the service that is produced by Fari, but the ins and outs of each trade, they are mine and they're my technical.
But what technicals do you like to follow?
Basically, what you got to do, technical analysis it's 3 or 4 major schools. You go into the supermarket, okay, and then you've got the grocery section, you've got the chemical sections, you've got the drink section, you've got this section. Technical analysis is a big supermarket. You got to choose your trend or your indicator that is either the MACD or the stochastics or the RSI. For me, I use a stochastic.
Okay.
Then you got to look at your chartism, at your chart. So you got to get to the classical chartism, trend lines. You do the moving averages. For me, the 55, the 100, and the 200 moving averages, whether it's a weekly chart, daily chart, or a monthly chart. The stochastics is very, very important. But I'll tell you something. It is not, for technical analysis, it is not what you use, but how you interpret it.
Great point.
So all of these things, listen to me. Yes, so all of these things, they are, quantitative. They strike you as very scientific. However, it's the way you interpret them, and that's why technical analysis, in its use, it's more art than science. So for me, it's the stochastics, and you look for the head and shoulders, you look for the patterns, the recognizable patterns, but it's the combination of the major moving averages. So for instance, in sterling dollar, we have a third death cross. 55 day moving average fell below the 100. It fell below the 200, but now we're probably going to see the 100 falling below the 200-day moving average, and that is what we told our premium subscribers, and that's one of the reasons that drove us to sell sterling. So yes, you look at the fundamental landscape, but you need the technical to give you the trigger.
One more for you. One more. Do you see Germany opting out of the QE and letting the other nations carry the load?
Opting out of QE. No. I think the Germans, they will have no choice, and Angela Merkel will have no choice. But you see, Draghi is going to work with Angela Merkel, and they will have to do QE. Why is that? Because people are criticizing the Germans for what? For not spending the savings that they have. This country, Germany, they have a surplus. It's a trading surplus. It is something that is inexistent in the developed world.
Okay.
But the Germans have it, but they're not using it. They're not spending it. They're not rebalancing the saving a glut in the eurozone. So they're not doing that. But what they will have no choice to do is to say yes to the demand of the QE, just in case they need to do. But the QE, it won't happen before November. It won't happen before December, because they still have an LTRO, which is the targeted long-term refinancing operations, which is basically you go to the restaurant, the bank goes to the ECB restaurant, and it pays very, very small money, like 0.05%, and it's an all-you-can-eat buffet.
Okay,
for 3 years, for 4 years.
We got to let you go, Ashraf. We have another guest coming on, but everyone in the chat room loved your comments. We hope to get you back on again soon. Thanks again.
All right, guys. Have a good one. Take care.
Thank you.